Warren Buffett, one of the greatest investors of all time, has been famously skeptical about Bitcoin. In fact, he's called it rat poison squared. But why does someone with a net worth of over $100 billion avoid something that's taken the world by storm? Bitcoin is currently worth more than $500 billion, with millions of people investing in it. But here's the shocking part: Buffett has never bought a single Bitcoin. While everyone else seems to be jumping on the crypto bandwagon, Buffett has stuck to his strategy of buying businesses with solid value and predictable profits. In this video, we'll dig into why Buffett refuses to touch Bitcoin, even as it surges in value. We'll uncover the reasons behind his decision and explain how his value investing approach completely clashes with everything Bitcoin stands for. Stick around as we break down Buffett's strategies, explore his deep mistrust of cryptocurrencies, and show you how you can avoid the mistakes many new investors are making. Chapter 1. The Timeless Wisdom of Buffett. A legacy beyond crypto. Warren Buffett has built his fortune on a single investing principle: buy what you know, and buy things with real value. He's been investing for over 70 years, carefully selecting companies with strong fundamentals. Buffett doesn't invest in trends. He looks for companies with a clear competitive advantage, a track record of consistent profits, and a strong management team. Bitcoin, on the other hand, has no earnings, no cash flow, and no way to measure its value based on the fundamentals Buffett trusts. It's purely driven by speculation. That's why Buffett stays away. He simply doesn't see it as a long-term investment. Bitcoin may have made millions for some, but for Buffett, it's not about fast money. It's about building wealth steadily, with real assets. Chapter 2. Bitcoin. The New Age speculation. Why Buffett calls it rat poison. In 2018, Buffett famously called Bitcoin rat poison squared. This wasn't just a random insult. He was pointing out the dangers of Bitcoin's speculative nature. Unlike stocks or bonds, which are tied to real companies or governments, Bitcoin is a digital asset with no tangible backing. Buffett's approach has always been about finding investments that are easy to understand and supported by real-world value. Bitcoin, in his eyes, is more like gambling than investing. It thrives on hype and fear of missing out, but it doesn't generate any real value. Without earnings or dividends, Buffett believes Bitcoin's price is purely driven by what people think it's worth, a dangerous game for anyone looking to build long-term wealth. Chapter 3. The Perils of Unpredictability. How Bitcoin shakes investor confidence. One of the key things Buffett looks for is stability. He wants investments that provide reliable returns, year after year. Bitcoin, however, is anything but stable. In 2021, Bitcoin surged from $30,000 to nearly $65,000 before crashing down again. That kind of volatility can shake even the most experienced investors. Buffett has often said that unpredictability makes him uneasy. When an investment's price swings by 50% in a matter of weeks, it's hard to see it as a safe bet. For most value investors, that's a red flag. So, when the price of Bitcoin can move 20% in a single day, it's clear why Buffett stays away. Bitcoin may bring huge profits in the short term, but it's not the kind of investment you can count on for the long haul. Chapter 4. Bitcoin's lack of intrinsic value. The core of Buffett's investing philosophy. Buffett's investing strategy is built on finding assets that have intrinsic value. That means businesses that generate profits, pay dividends, and have a strong market position. Bitcoin, however, has no intrinsic value. It doesn't produce anything, and it doesn't have a reliable income stream. While gold has been seen as a store of value for thousands of years, it still has physical properties. You can touch it, melt it down, and use it in electronics. Bitcoin? It's just a string of code stored on a server. Without any inherent value, Buffett believes Bitcoin is little more than a speculative asset, much like any other bubble throughout history. Chapter 5. Bitcoin's fallacy as digital gold. Why Buffett thinks it can't replace real assets. Many Bitcoin proponents argue that it's the digital gold of the future, a hedge against inflation, and a store of value. Buffett doesn't buy this argument. In his view, Bitcoin simply doesn't have the qualities that make gold a valuable asset. Gold is rare, durable, and has been recognized as valuable for thousands of years. It has real-world uses and can't be duplicated in the way Bitcoin can. Bitcoin's value depends entirely on belief. If people stop believing in it, its value collapses. Gold, on the other hand, has a long history of maintaining value, even in uncertain times. That's why Buffett has always preferred traditional assets, like stocks in well-managed companies, over digital tokens that might vanish with the next wave of technological change. Chapter 6. Crypto Hype versus Value Investing. How Buffett stays focused on the fundamentals. In a world dominated by headlines about the next big crypto breakthrough, Buffett remains focused on what matters: value. He's not swayed by the hype surrounding cryptocurrencies. His strategy has always been simple: find businesses that are undervalued and hold them for the long term. When everyone is chasing the latest trend, Buffett stays calm and focused on building wealth through reliable, income-generating assets. If you're new to investing, it's easy to get swept up in the excitement of the next big thing. But Buffett's strategy teaches us that true wealth is built slowly and steadily. If you want to avoid the pitfalls of speculation and cryptomania, it's essential to stick to what you know and follow the fundamentals. If you're enjoying this deep dive into Buffett's approach, don't forget to subscribe and hit the notification bell for more insights into the world of value investing. Stay tuned as we continue exploring how to build wealth like Buffett, and why sticking to a time-tested strategy can pay off in the long run.